Hello, my name is Edmond Jamna, and on behalf of DW Consult, I want to welcome you to Tutorials on the Go. Our zeal here is to help transition people with zero, struggling, or shaky base in accounting to an expert position and to a place of confidence. It is also a platform to assist in the smooth studying of the ACCA and ICA professional qualifications, as well as for any tertiary accounting discipline. All that is required of you is to subscribe to our channel and click on the notification bell as well to be part of the program. Tutorials on the Go, bringing accounting to heart. Now, to this episode's lecture, non-controlling interest. Now, in the previous discussions, we looked at the situation where the company has absolute ownership of the subsidiary. In this very episode, we will be looking at when the parent company owns less than 100% but still maintains control over the subsidiary. So, non-controlling interest, also known as the minority interest, is the residual holding in a subsidiary after the parent share. So if you look at the chart, the entire circle is the holding of the subsidiary. So if the parent owns 75% of their shares, the rest of the 25% will be the non-controlling interest. It can be an individual or an entity or entities. Okay. So here, when there is the presence of a non-controlling interest, the parent still maintains control over the subsidiary and must prepare consolidated financial statements. Secondly, the assets and liabilities of the subsidiary are to be consolidated 100% on a line-by-line basis. Then lastly, the non-controlling interest in the subsidiary must be presented in the equity column of the consolidated statement of financial position. Let's quickly look at the calculation of the non-controlling interest at acquisition. So the value of the non-controlling interest at acquisition is measured using either of the following methods. 1. The proportionate share of the net assets of the subsidiary. So here the percentage of the holding of the non-controlling interest is tracked on the total net assets of the subsidiary at acquisition. So the net asset at acquisition will be the share capital plus the retained earnings at acquisition. The second method of calculation will be the fair value. So here the number of shares of the non-controlling interest is calculated at its fair value of the subsidiary's share per unit. Okay. So either the total value of the non-controlling interest is quoted, especially in an examination, or the fair value of a share will be provided, which is to be multiplied to the number of holdings shares in the subsidiary by the non-controlling interest. Let's test our understanding. So a parent company buys 75% of the equity shares in a subsidiary company for $156,000. The number of ordinary shares of the subsidiary is 100,000 with a share value of $1.6. The net asset at acquisition were $170,000. So we are supposed to calculate the non-controlling interest, assuming it is measured using the proportionate share of the net asset method or the fair value method. We quickly look at the solution. So under the proportionate method, the non-controlling interest at acquisition will be $42,500, which is the 25% multiplied on the net assets of the subsidiary. Okay. The second method, which is the fair value, will give a value of $40,000, which will be the $1.6, which is the value of the subsidiary share, multiplied by the number of shares that the non-controlling interest holds, which is 25,000, arrived at multiplying the 25% holding on the total shares of the subsidiary, which is 100,000. Okay. Let's look at non-controlling interest on consolidation. So here, you pick the investment of the non-controlling interest, how much they paid to own the shares that they have. Then you add their share of post-acquisition reserve. Okay. Here, the total value would have been credited to the parent if he had absolute control. But now that there is a presence of non-controlling interest, they will share in the retained earnings. That will give the non-controlling interest to be shown in the equity column of the consolidated statement of financial position, as alluded to earlier. Okay. This is when the fair value method is used in calculating the acquisition value of the non-controlling interest. Now, when the proportionate method is used, you have to first prepare a calculation non-controlling interest share of goodwill. When you use the fair value method, the goodwill is solely attributed to the parent. So you first start by bringing the non-controlling interest, the cost of investment here, then their share in the net assets at acquisition, which will be the percentage holding multiplied by the subsidiary's total net asset at acquisition. The difference will give you the goodwill, which is supposed to be attributed to the non-controlling interest. After that, then you proceed to calculate their value. So you also start with their cost of investment at acquisition. Then you bring their share of retained earnings, which will be their percentage holding on the total retained earnings at the date of consolidation, not the post-acquisition profit. Then you bring the share of the goodwill, which is the calculation above here, which will lead to the non-controlling interest at consolidation. Now this figure should be the same as that calculated under the fair value method. Let's now look at goodwill at acquisition with the introduction of a non-controlling interest. So goodwill, as we have already discussed, is the excess of consideration or cost of investment over the net assets of the subsidiary. So now that there is the presence of a minority interest, the cost of investment will not be coming in solely from the parent, but from the non-controlling interest as well. So when we come to the format for the calculation of the goodwill, we pick the cost of investment from the parent. We add that of the non-controlling interest at acquisition, giving us the total consideration paid to have a stake in the subsidiary. So then we have to less the fair value of the net assets of the subsidiary at acquisition, which is the share capital of the subsidiary, then the retained earnings at acquisition. So the total will have to be less from the total consideration, which will now give the goodwill. Let's test our understanding again. So P acquired 60% of the shares of S on 1st January 2017, when the retained earnings of S stood at $6,000. So the fair value of non-controlling interest at the date was $30,000. So on 31st December 2017, the statement of financial position of each of the two companies were as follows. So we have the non-controlling interest for both, the investments in S, current assets, total assets of $104,000 for P and $42,000 for S. We have the share capital for both companies, the retained earnings for both companies, then current liabilities also for both companies, which will also give a total equity and liability section of $104,000 for P and $42,000 for S. You are supposed to calculate the amount of the goodwill and non-controlling interest arising on consolidation. So when we move to the solution, the goodwill, as we know, we pick the cost of investment for the parent, which is $40,000. That of the non-controlling interest. Here you realize that it was stated, so it means you are using the fair value method, which is $30,000. The total investment is $70,000. When we come to the net assets of the subsidiary at acquisition, the share capital is $20,000. The pre-acquisition profit also stated in the question is $6,000, giving a total net assets at acquisition of $26,000. When we less it, we are getting goodwill on acquisition of $44,000. Now when we come to the non-controlling interest on consolidation, when we come to the fair value method, we pick the fair value of the non-controlling interest at the date of the acquisition, which is $30,000 as stated. Then we pick their share of the post-acquisition profit, which is $4,000. The total will be $34,000. Let's come to the proportionate method. So we first have to calculate the goodwill to be attributed to the NCI, which is the fair value at the date, which is $30,000. Then the net assets to be attributed to the NCI, which is the 40% plus the $20,000, the share capital, plus the $6,000, which is the retained earnings at acquisition. When we less it, the goodwill to be attributed to the NCI will be $19,600. Then we now come to calculate the value for the non-controlling interest on consolidation. So we again bring the NCI at the date of acquisition. We will use the proportionate method. So we pick the 40% holding of this non-controlling interest. Then we multiply it on the share capital of the subsidiary, $20,000, giving a value of $8,000. Then we bring the share of its retained earnings. Again, you pick the 40%, multiply on the total retained earnings at the date of consolidation, not the post-acquisition. So $16,000, giving $6,400. Then we bring the goodwill, which is supposed to be credited to the NCI, the calculation done above of $19,600. It will give a total of $34,000, which is the same as that worked under the fair value. Let's test our understanding for the last time on this episode. On 1st January 2020, Gladys Co. acquired 75% of the share capital of Emilia Co. for $1,380,000. The following statement of financial position for the two companies have been prepared on 31st December 2020. So the investment in Erica Co. is shown here. You have the other assets for both companies. Then the total asset is $5,880,000 for Gladys, $2,400,000 for Emilia. So when you come to the equity, it's all shown for both companies. You have the retained earnings for both companies listed here, then liabilities for both companies, also giving a total of $5,880,000 for the equity and liability column. Then you have $2.4 million also for Emilia. The retained earnings of Emilia Co. at the date of acquisition was $480,000. Okay. Emilia Co's share capital has remained unchanged since the acquisition. The non-controlling interest was valued at $450,000 as at 1st January 2020. We are required to prepare a consolidated statement of financial position at 31st December 2020 for the Gladys Group. For the solution, the other assets will provide a value of $6.9 million. The Goodwill, which will show the calculations very soon, will provide a value of $350,000. The investment again will be ignored as a matter of principle in the preparation of group accounts. The total asset column will be $7,250,000. Now, the equity column will only list that of the parent, $2 million. Retained earnings, the workings will be provided very soon, $2,175,000. The non-controlling interest, which the working will also be shown soon, $495,000. Then the liability also will be $2,580,000. The total column also be $7,250,000. Okay. So when we come to the workings, for Goodwill, Gladys's cost of investment is $1,380,000. That of the non-controlling interest is $450,000. The total will be $1,830,000. So net asset at acquisition will be share capital of $1 million, the pre-acquisition profit of $480,000, which will be $1,480,000. When we find the difference between the two, it will provide a goodwill of $350,000. When we come to the retained earnings also, Gladys's own is $2,040,000. Then her share of the post-acquisition reserve of Emilia, which is 75% of $180,000. $180,000 is the difference between the retained earnings to date of $660,000 less the $480,000 at acquisition will be $135,000, which will provide a total of $2,175,000. When we come to the non-controlling interest, their cost of investment is $450,000. Their share also in the post-acquisition reserve of Emilia will be $45,000, total of which will be $495,000, also captured in the consolidated statement of financial position. All too soon, we come to the end of this episode's lecture. I hope it went well. If you have any comment or feedback for us, do well to drop them in the comment section below. Whilst at that, kindly subscribe and turn on all notifications to stay abreast with our postings. Also, follow us on our various social media handles as captured on the screen. Join us on another episode of Tutorials on the Go. Until then, take care of yourself and stay blessed. Poker.